Now, another question that clients have asked is about Greece, Spain, and Europe. And they'd like to know what are the short-term and long-term impacts of those economies on the U.S. stock market.
I think that the Euro crises or the Greek crisis or Portugal or even Spain getting in the headline, this is the unfortunate thing about just listening to the press, whether the media, the television, the radio, the newspapers. They're trying to sell their media, and so they always exaggerate and overemphasize things. But if you really look at it, let's take a look at it from a factual standpoint. You know, facts are a stubborn thing, and they resist a lot of this kind of media stuff. So let's take a look at the perspective of Greece. Now, I don't know how many newspaper headlines I've seen where Greece is at the top of the headlines, not only in the business section, but regular newspapers. So let's put it into perspective. The world GDP, that is the total economic activity, if you put all of the world together, is $61 trillion. So that is the total pie. You've got a $61 trillion pie. And then you've got Greece, which is $356 billion. So if we put that into perspective, you've got $61 trillion on one side, and you got $356 billion on the other side, and that is 0.58 of 1%. In other words, Greece is half of 1% of the world GDP. Now, when you put all of that into economic perspective, and when you see it rolling financial markets, you can see that to spend that much energy on 0.5% of the world's GDP is, sure, you got to solve the problems, you got to fix the banks, you've got to fix all the pension funds, you've got to get the Greece economy back on the feet so that the people have a future. But as far as that impacting, irrespective of what happens to Greece, I think for a 0.5 of 1%, it's overly emphasized. Now, if we want to take Portugal, Portugal is $243 billion out of the 61 trillion, so it's even smaller than Greece. So that puts you at 0.40%. So if you put Greece and Portugal together all in one ball, you'd have less than 1% of GDP. Again, if you put it into perspective, the headlines are overemphasizing the importance or the damage that those economies can do over the long run to the world GDP. Now, Spain is another matter. Spain is 1.6 trillion in GDP. It's about 2.5% or 2.6. While it is obviously larger than Greece and Portugal, they are in much better shape. Their debt to GDP is actually better than ours. And so while they've been downgraded from the top rating, they're not anywhere near where Greece is. But again, in perspective, it's 2.6% of GDP. Just to put it in perspective, Massachusetts is about the size of Greece. So if you want to say, if something happened to Massachusetts, how would it affect America? I would say it would have an impact, but relative to America, there's a lot more to America than Massachusetts.
Now, there's been some talk recently, or questions in the media about the euro and its sustainability, and some questions of whether it's going to survive.
I can't believe that the euro would ever stay together over the long run. When you have good times, even people that don't like each other can get along pretty well. When you have bad times, sometimes friends don't even get together. So when I look at these nations in the euro, and I thought, geez, they were mortal enemies at one time, their culture are so different, they're all going to run for their own hide when things get tough. How do they expect all of these people during bad times to stay together? And so maybe I've been wrong about the fact that they wouldn't stay together, but certainly now is a testing time. And my approach is one or two or some of those countries may have to leave the euro if somebody won't bail them out. But even if they is, it's not the end of the world, because their impact is less than 0.5 to 1% of the GDP. So I don't think it's going to make any difference. But the fact that the euro is going down is actually good for Europe, because just like when the dollar was declining, it makes our exports more competitive. as the euro dollar is going down, it will make the European countries more competitive. And let me say one thing. Europe's export is about 40% of GDP. Ours is only 11%. So they depend heavily on foreign trade. If their currency is overvalued, they're not going to be doing much in trade. So the fact that their currency is going down is actually a good thing for them because it'll make their goods more competitive. Another factor that I would like to point out is that even Greece and Portugal and Spain or anybody else who can get into financial trouble is not going to be that much of a problem long term because, you see, I always have this rule. When you lend a guy a little bit of money, you're a lender. When you lend him a lot of money, you're his partner. He goes down, you go down. Well, China has 40% of their GDP in exports. Half of that is about us, 20% of that. The rest, a lot of it is to Europe. China has $2 trillion in reserves. Now, from an enlightened point of view, not from an altruistic point of view, I will never make the suggestion that China is going to do anything altruistic. But from an enlightened self-interest point of view, China is going to do what they can to bail out Europe because it's 50% of their export. And so when you depend that heavily on those customers, you're going to want to do everything you can to prop them up and make them go over the long run, because while it might take some money to shore them up in the short term, over the long term, they're excellent customers. They're 50% of your exports, and you're going to do what you can, just like we do what we can to bail out other countries, not because of our altruistic reasons sometimes, but just because of our enlightened self-interest. So it is in China's interest, as well as it is the rest of the world, to keep Europe going, because Europe is about 1/3 of world GDP, and overall that's significant.
Now, if something does happen to the euro or it continues to fall, that could impact a lot of U.S. multinational companies, and we own a lot of large blue chip multinational companies. So how would it impact the earnings of those types of companies?
Europe has slowed down just like we did in the recession, and so the multinational companies have already suffered some erosion of sales and profits. I would say as the euro goes down, that will actually improve. And so one of the things that I love about our multinational companies, we are not only diversified in America, but 50% of the sales of those multinational companies comes from Asia, Europe, and places all over the world. So we have basically a call on world GDP. So maybe Europe is slowing down, but China has been growing at 8, 9, and 10% GDP. Now, I'm not saying that that's sustainable necessarily, but we have the benefits of having participated in growing economies and also having participated in slower economies. But I think with the euro going down, long term, not short term, long term, that's going to be positive for European sales and profits, and it'll be profitable for our multinational company. But maybe at that time, China will be slowing down. We don't know. But I would rather have a diversified income stream from all over the world, because you have some faster growing, some slower growing, than just be only in a slowing growing economy. So while a lot of people invest in other countries overseas, the way we get our diversification is by investing in multinational companies. And by the way, those American international companies are, in my opinion, has been for the last 2 years, are the cheapest value-add companies for the last 25 or 30 years compared to interest rates. So they are...
So these large cap stocks are as cheap as you've seen them in 25 to 30 years?
I would say compared to interest rates.
Compared to interest rates.
Not as cheap as they've been. They've been about 3 times they've been as cheap as this, but they have not been as cheap as this when you compare them to interest rates. So they are true value, and they represent about 60 to 70% of our portfolio, depending on the client.